First off, it was the attack was done, a day or 2 days before Sunday's scheduled peace talks. So from that standpoint, you could look at it as a Pearl Harbor. If you look at, you got to look at the reasoning behind what's happened. Iran was on the list. And this list goes back to the year 2000, 2001, where they had, I forget all of them. I think it was Yemen, Iraq, Iran, Syria, Libya. That was a hit list, and Iran is, one of the remaining on the hit list. You could also look at it from the standpoint of liquidity's getting tight, and historically, the way to ramp up an economy is to go to war. So, now you've got the military-industrial complex is going to be fed again. Do I think the U.S. is going to join in this? I certainly hope we do not, but it looks pretty imminent. I mean, what did we do? We've sent refueling aircraft to that region. We're relocating naval assets. To me, it looks like the U.S. will join. You'd have to be actually in the backroom discussions to know whether or not Israel acted on their own or not. My biggest concern is that Russia jumps into this, and understand that Iran is a major supplier of oil to China. And they've just signed a bunch of, over the last year, they've signed a whole bunch of trade deals guaranteeing them X amount of oil. Is that oil going to even be produced after the smoke clears? So, the danger is that Russia gets involved, China gets involved, you're talking about a world war.
Normally, when oil prices rise on these sorts of headlines, wars, geopolitical news, it tends to drop back down again. Do you think this time could be different and we might see a more sustained rise in the oil price if this conflict continues?
Well, yeah, as of this morning, it's different. We've already had 2 tankers in the Strait of Hormuz that collided. You've got one that's on fire. I don't know the likelihood of it sinking, but obviously that would be an ecological disaster. But if you start plugging up the Strait of Hormuz and that's not able to be used, that's 20% of all the oil that's transported worldwide. So, that's, you're putting a crimp in supply right there. If this does go hot, it's already hot, but if the U.S. does join in, if Russia follows, if China follows, I've seen numbers of $130 oil. I think it's plausible you could see $300 oil, depending upon, what happens to the infrastructure of Iran producing oil. Does anything would anything flow through the Strait of Hormuz? Probably not.
All right, let's get right into this, because there's frankly no time to waste sugarcoating it. Where we stand today, whether we're talking about the United States, Europe, or the broader Western financial system, is on the brink of what I would call a monetary and social inflection point. I've been saying for years that we were heading here, and now you can see the dominoes lining up faster than most people can process. Let's start with the debt, because everything else flows from that. It's like the water table under a city. You might not see it directly, but it supports or undermines the entire foundation. When I first started seriously studying this stuff decades ago, the US national debt was roughly $1 trillion. I remember thinking even back then, man, how do we ever pay that off? Fast forward to today, we're pushing $35 trillion in official national debt. And if you add in the off-balance sheet stuff, the unfunded liabilities like Medicare, Social Security, pensions, and all that, you're easily talking $180 to $200 trillion in obligations that someone's supposed to pay. Here's the blunt reality. That's mathematically impossible to pay back in today's dollars. And the people who run the show, the politicians, the central bankers, the think tank guys, they know it. They're just trying to stretch out the timeline so it doesn't blow up on their watch. That's all this game has been about for the last 20, 30 years. Extend, pretend, hope the music keeps playing long enough that it becomes the next guy's problem. Now, if this were just a story about the US, maybe you could argue it's contained. But look around. Europe's in the same boat. Japan's even worse. China's carrying an obscene amount of debt through local governments and state-owned enterprises. This is not a localized problem. It's systemic. It's global. It's foundational. And the only way out of a debt trap like this, historically, has always been one of two options: austerity and paying it down, which is politically impossible, because voters will riot before they let their benefits get slashed. Inflate it away, print the money, degrade the currency, make the debt easier to service in tomorrow's cheaper dollars. Guess which path every major government in the world is choosing right now? So here we are, with central banks pretending to fight inflation by raising rates from 0 to, 5%? After a decade of ultra-low interest rates, free money for Wall Street, and more derivatives leverage than ever before, they act shocked that inflation didn't magically evaporate. Meanwhile, they're still growing their balance sheets through the back door, with repo operations, emergency bank rescues, stealth QE, you name it. But here's where it gets even more twisted. As these debt burdens rise, and interest costs alone eat up more of national budgets, the incentive to print gets bigger. If the US has to roll over $10 trillion in debt this year at 5%, that's $500 billion just in interest. That's before you fund a single aircraft carrier or cut a social security check. So you either print or you default. That's it. And that's where the smart money starts looking for lifeboats. Now let's shift gears to gold and silver, because that's really what this all comes down to in the end. What's going to protect you when the fiat system hits the wall? You know, for decades, we've watched this managed suppression of precious metals prices. You've had big bullion banks, JP Morgan, HSBC, and the rest, shorting the paper gold and silver markets through COMEX futures, keeping prices contained. Why? Because gold and silver are direct competitors to fiat currency. They're the canaries in the coal mine that reveal monetary mismanagement. A rising gold price doesn't mean gold's getting more valuable. It means your dollars are worth less. That's embarrassing for the Fed, for the Treasury, for the entire debt Ponzi. But suppression only works for so long. Eventually, the physical markets overwhelm the paper markets. We're seeing that now with record central bank buying. The World Gold Council shows central bank gold purchases at all-time highs. China, Russia, India, they're all stacking. Why? Because they know where this is headed. I've joked many times that China reads the same balance sheets we do. They see US debt to GDP, they see the money supply charts. So what have they done? For years, they've been quietly buying up gold, building bilateral trade agreements outside the dollar, setting up their own SWIFT alternatives. They're preparing for a post-dollar world. Meanwhile, the average American's buying meme stocks and Dogecoin.
So you really can't put a number on where oil's going to go. But like I said, if we see this expand into a worldwide conflict, the price of oil is going to go stratospheric. I would just say that the first casualty of war is truth. And I just posted last night that they did not have intelligence that Iran was close to a nuclear weapon or even trying to build nuclear weapons. So, who's telling the truth? Was she lying? Was she, ill-informed? I don't know, but I think it's pretty convenient to come out and say that, Iran's just a few days away from a nuclear weapon and Israel launches.
Yeah, and Benjamin Netanyahu has been accusing Iran of being about to build a nuclear weapon for a very long time. I think it's back to the 90s. So this does not seem a super plausible reason to be attacking the country. I wonder what your opinion is on the potential of a false flag being instigated to get the American people behind the war.
Yeah, I do. And I think the answer to your question is probably 99.9% chance that there is a false flag somewhere. I mean, obviously there's a chance that doesn't happen. But I think it's extremely likely that it will happen. And I can almost guarantee you that the false flag will not be a carrier going down. Can you imagine what markets would do? Can you imagine what the dollar would do if it was shown that the U.S. is not the biggest, baddest bully on the block any longer?
Yeah, that's an interesting point.
Let me add to that. I mentioned the dollar. Let's look at treasuries. What happens to treasury auctions? Do you have the safe haven flight of capital coming to the U.S. or going somewhere else? And that somewhere else most likely would be gold and silver or other hard assets. Under the scenario of a carrier going down, the treasury market would be in total convulsions. The dollar would probably take a 5% hit. I don't see that scenario happening, but nothing's off the table.
So let's keep pulling on that thread, because frankly, it's one of the most important topics out there right now. When you bring war into the picture, especially a war that risks pulling in Russia, China, the United States, NATO, Iran, and their proxies, you're basically talking about throwing a grenade into an already unstable global financial system. People don't realize just how thin the ice is. The average American is worried about whether they can still afford chicken wings and a six-pack for the game on Sunday. They're not watching the treasury market. They're not following repo spikes or looking at who's buying the long end of the curve. But if you're paying attention, you can see the stress fractures everywhere. Let's start with the dollar and treasuries. Historically, yes, whenever there's geopolitical turmoil, there's a flight to safety. The knee-jerk reaction has been to buy dollars and treasuries. We saw that in every crisis from the Asian financial crisis in '97 to the Euro debt crisis in 2011. The problem is, the fundamentals that underpin that flight to safety are gone. The US government is over $34 trillion in debt. That's just the on-balance sheet number. Add in unfunded liabilities for Social Security, Medicare, government pensions, and you're north of $180 trillion. You can't pay that back in today's dollars. The only way out is default or devaluation, and governments never choose explicit default. They pick stealth default via inflation. Foreign central banks know this. That's why for the last decade, they've been net sellers of US treasuries. China used to be the biggest holder of our debt. Now they're offloading. Japan, same story. Even the Saudis are dialing back. They're all diversifying into gold. You see it in the numbers. The World Gold Council shows central bank gold buying is at all-time highs. Why? Because they're preparing for the post-dollar world. Now let's add war into that powder keg. Say you have a shooting war that escalates, maybe a US carrier gets hit, or Russia openly intervenes on Iran's behalf. Oil shoots to $300. Inflation explodes globally. Do you really think that's bullish for treasuries? If you're China sitting on $1 trillion in US debt, you're going to look at that and say, I'm getting out while I still can. And what does that mean? It means treasury auctions start to fail. It means yields spike, which means the cost to service US debt skyrockets. That's the doom loop. More debt means more interest payments, which means bigger deficits, which means more printing to cover it, which means more inflation, which means even higher rates. At some point, the bond market breaks. That's when you see true panic. Now people might say, but Bill, won't the Fed step in and buy all the debt? Of course they will. They have no choice. They'll start yield curve control just like the Bank of Japan. They'll monetize everything in sight. But what does that do? It torpedoes the dollar. Because then everyone knows there's no restraint, no pretense of fiscal responsibility. It's outright monetization. And that's when gold and silver go vertical. Not because they're suddenly better assets, but because the denominator, the dollar, is being destroyed. That's the part people always miss. It's not that gold is rising, it's that your dollars are buying less. Same for oil, same for groceries, same for everything. Now, let's circle back to this idea of false flags and manufactured crises. Throughout history, when governments get into a bind financially, they reach for the oldest trick in the book, external conflict. It unites the population, distracts from domestic failures, and justifies emergency measures. In 64 AD, Nero burned Rome and blamed the Christians. In the 1930s, Japan staged the Mukden incident to justify invading Manchuria. The Gulf of Tonkin got the US deeper into Vietnam. Weapons of mass destruction got us into Iraq. So, is it so hard to imagine that some convenient incident might emerge here? Whether it's real, exaggerated, or outright fabricated doesn't matter. What matters is, it provides cover for extraordinary actions. And let me tell you, the financial establishment will love it. War is the ultimate justification for unlimited spending. The military-industrial complex gets fat contracts. Politicians get to wave flags and avoid tough economic questions. Central banks get cover to print under the guise of national security. Meanwhile, the average person pays the hidden tax through inflation. But here's where it gets even more dangerous. Because unlike the post-Wabblesy Tooth period, we no longer have an industrial powerhouse that can outproduce the world. We've offshored our manufacturing, hollowed out our supply chains, and replaced productive capacity with financial engineering. That means any prolonged conflict that disrupts global shipping, or access to critical minerals, or energy flows is going to expose just how fragile the system really is. Let's talk practical. What does all this mean for precious metals, especially silver? Well, as I said earlier, you're dealing with the most manipulated commodity on Earth. For decades, the big banks have shorted the paper market to keep the price suppressed. Why? Because a high silver price exposes monetary debasement. It also would make it clear how under-collateralized many of these ETFs and unallocated accounts really are. But when the music stops, when the shorts can't roll their contracts, when deliveries are demanded and can't be met, when investors globally panic out of paper and into physical, the price is going to shoot so high that most people won't believe it. Remember 1980. Silver went from $5 to $50 in a blink. That was with a tiny fraction of today's monetary base and derivatives exposure. Adjust that for 40 years of monetary inflation, and we're talking 300, 400 silver, just to match that move in real terms. And in a true panic, who knows where it ends? Same with gold. Look at how gold moved after Nixon closed the gold window in 1971. It was $35 an ounce then. By 1980, it was $850. That was a 24 times move. Apply the same multiple from today's base of $2,300, and you're looking at $55,000 gold. Now, I'm not saying that's tomorrow's price. Markets rarely move in straight lines, but it gives you a sense of scale. People scoff at these numbers. They say it's impossible, but history says otherwise. The impossible becomes inevitable when confidence breaks, and confidence is a fragile thing. It's lost slowly, then all at once. Now I know some will still say, but Bill, won't the system just reset? Won't we just go to a digital dollar or some new IMF SDR basket and solve the problem? Maybe, but ask yourself, would you trust a new currency system run by the same people who destroyed the old one? Trust doesn't reset with a press release. It has to be rebuilt, and that takes time. Meanwhile, people will demand hard assets. So here's what I see happening. The first phase will be more of what we've already seen. Slow motion crises, more money printing to paper them over, and creeping inflation. The next phase is where something snaps. Maybe it's a treasury auction that fails. Maybe it's a geopolitical incident that sends oil to $300. Maybe it's a run on the COMEX. That's when the crowd wakes up all at once, and by then, it's too late to position. That's why I keep hammering the same message. You want to be early, not trying to fight your neighbor for the last maple leaf at the coin shop. You want your insurance in place before the house catches fire. And one final note on human psychology. When the crowd finally does wake up, they won't behave rationally. They'll panic. They'll overpay. They'll sell good assets to chase bad ideas. They'll buy gold at $10,000 because they're terrified, even though they laughed at it at $2,000. That's just human nature. It's why cycles exist. My advice? Keep it simple. Own physical gold and silver. If you want some leverage, own the miners. But understand they're more volatile. Have some cash for short-term needs and opportunities, but know it's melting ice. Stay out of debt to the extent you can. Build real relationships and skills. Because in a world where trust is breaking down, trust in currencies, trust in institutions, trust between nations, the most valuable assets are going to be tangible and local. I'll close with this. You don't need to fear what's coming if you prepare for it. The people who see the writing on the wall and take steps now are going to be the ones buying up choice properties and productive businesses when others are forced to sell. That's how generational wealth is made, by being liquid and prepared when opportunity collides with panic. So keep your head, keep stacking, and remember, they can print as many dollars as they want, but they can't print more gold or silver. That's your edge. Use it.